Welcome to another economics lesson. For this lesson, we are going to focus on measures used to correct macroeconomic problems. Our objectives include to discuss measures used to correct macroeconomic problems in an economy. So we will look at the use of government policies to correct problems associated with inflation, unemployment, and recession. Now, one government policy that can be used to address macroeconomic problems is fiscal policy. And fiscal policy is the use of government spending and taxation to influence the economy. So governments use fiscal policy to influence the level of aggregate demand in the economy in an effort to achieve the economic objectives of price stability, full employment, and economic growth. Fiscal policy is based on the work of economist John Maynard Keynes, and it is different from monetary policy, which can be used to achieve the same objectives. However, monetary policy is used by the central bank, and it is used to influence money supply and interest rates, while fiscal policy focuses on government spending and taxation. So, with fiscal policy, there can be an adjustment of the level and composition of taxation, as well as the level of government spending in an economy. There are three main types of fiscal policy. There is a neutral fiscal policy, which is used when the economy is in equilibrium. It's basically used to maintain the equilibrium. There is expansionary fiscal policy, which focuses on lowering taxation and increasing government spending. And the aim is to allow consumers to have more disposable income, so it will increase the aggregate demand in the economy. And then there is contractionary fiscal policy, which aims at lowering government spending and or increasing taxation to reduce the amount of disposable income that's available to consumers. And this can have the effect of lowering aggregate demand. So, expansionary fiscal policy could be used to influence aggregate demand. If expansionary fiscal policy is used, it will allow more disposable income to be available to consumers who can purchase more goods and services in an economy. And because the demand will be influenced by a change in income, which is a non-price factor, it would cause the aggregate demand curve to shift to the right. Now, Keynes proposed that during a recession, the best strategy to use would be for there to be expansionary fiscal policy where government spending would increase and tax rates would decrease. This was proposed to be the best way to stimulate aggregate demand, and he argued that this approach should be used in times of recession or low economic activity as an essential tool for building the foundation for strong economic growth and working towards full employment. So in theory, the resulting deficit would be paid for by an expanded economy during the boom that would follow. So if the government would increase its spending, even if they would do deficit spending, they were spending more than they were earning, eventually the economy would get back on track and will start to grow. And so whatever they would earn in the periods of growth would be enough to cover the deficit that was incurred while trying to stimulate the economy. So, if taxes are reduced, more disposable income would be available for consumption. And this would cause the aggregate demand curve to shift to the right. And an increase in government spending combined with reduced taxes would also allow the AD curve to shift to the right. So, the extent to which the AD curve would shift to the right would depend on the government spending and the multiplier effect, which would be the ripple effect from the initial spending that is done. Now, for unemployment, an expansionary fiscal policy is also considered to be useful. If the government is trying to lower unemployment and it uses an expansionary fiscal policy, which is targeted at either making direct investment in terms of boosting production and increasing production facilities through expansion or construction of new facilities, then this will directly be a need or provide a need for additional labor. In addition, if it would, for example, increase the wages of public sector workers, then this would allow more persons to have an increased amount of disposable income. They could go out and purchase more goods and services, increasing the demand for businesses who can respond by producing more. And in order to produce more, they need to hire more workers. So this is how it would lower unemployment. For inflation, the Keynesian theory proposes contractionary fiscal policy. Note that inflation means that there's a consistent increase in general price levels. So if there's a reduction in government spending and an increase in taxation, this would lessen the amount of disposable income that consumers have access to. And so this would lower their demand, and this would help to stabilize inflation, because if inflation is caused by demand pull and consumers have less disposable income, then it would help to stabilize inflation if consumers are demanding less goods and services. And so a contractionary fiscal policy would cause there to be lower demand, and therefore the demand curve would shift to the left. In addition, if the tax revenues exceed government spending, it would also allow for there to be a budget surplus. These are some of the sources used to compile the content for this lesson.